The global economy continues to recover amidst ongoing policy support and improving financial market conditions. The recovery process is led by emerging economies, especially those in Asia, as growth remains weak in advanced economies. Despite signs of renewed activity in manufacturing and initial improvement in retail sales, the prospects of economic recovery in Europe are clouded by the acute fiscal strains in some countries. Let's understand the impact of RBI treatment on health of economy through trade, finance, and confidence channels. At first, recovery occurs in US, owing to huge increase in money supply through government bailout program, and this situation moves to other emerging market economies. In case of India, the impact of these changes in US economy were transpired through trade and finance channels, which resulted into recovery in exports of merchandise goods and services and huge inflow of financial capital inside the country, which further resulted in few economic events such as: first, net export increased due to improvement in demand for Indian goods and services in US. Second, lower yields in financial market due to increase in capital flow from developed economies in search of higher returns and carry trade opportunities. Third, more investment in greenfield and whitefield projects due to improved sentiments of foreign investors. Last but not the least, stock market recovers due to higher demand of Indian stocks by FIIs, as a result of which aggregate demand in India started recovering in faster pace. These events affected household and firm decision-making through confidence channel due to the following reasons: soundness of Indian financial system, quick and agile policy responses from government and central bank, rising inflow of foreign funds from institutional and direct mode, rising stock market, and efficient financial intermediation. Domestic economy. After a continuous decline for 11 months, imports expanded by 2.6% in November 2009, 32.4% in December 2009, 35.5% in January 2010, and 66.4% in February 2010. After contracting for 12 straight months, exports have turned around since October 2009, reflecting revival of external demand. Various lead indicators of service sector activity also suggest increased economic activity. On the whole, the economic recovery that began around the second quarter of 2009-2010 maintained a sustained improvement. The uptrend in industrial activity continues. The Index of Industrial Production, that is IIP, recorded a growth of 17.6% in December 2009, 16.7% in January 2010, and 15.1% in February 2010. The recovery became more broad-based, with 14 out of 17 industry groups recording accelerated growth during April 2009, February 2010. The sharp pickup in the growth of the capital goods sector in double digits since September 2009 points to the revival of investment activity. On the demand side, the contribution of various components to growth in 2009-2010 was as follows: private consumption 36%, government consumption 14%, fixed investments 26%, and net exports 20%. The monetary and fiscal stimulus measures initiated in the wake of the global financial crisis played an important role. First, in mitigating the adverse impact from contagion, and then in ensuring that the economy recovered quickly. Signs of perennial disease, that is inflation. However, the developments on the inflation front are continued to be worrisome. The headline inflation as measured by year-on-year variation in wholesale price index, accelerated from 0.5% in September 2009 to 9.9% in March 2010, exceeding the Reserve Bank's baseline projection of 8.5% for March 2010, set out in the third quarter review. Year-on-year WPI non-food manufactured products, which weighs about 52.2% in GDP inflation, which was minus 0.4% in November 2009, turned marginally positive to 0.7% in December 2009 and rose sharply thereafter to 3.3% in January 2010 and further to 4.7% in March 2010. Year-on-year fuel price inflation also surged from minus 0.7% in November 2009 to 5.9% in December 2009 to 8.1% in January 2010 and further to 12.7% in March 2010. Despite some seasonal moderation, food price inflation remains elevated. Clearly, WPI inflation is no longer driven by supply-side factors alone. The contribution of non-food items to overall WPI inflation, which was negative at minus 0.4% in November 2009, rose sharply to 4.7% by March 2010. What was initially a process driven by food prices has now become more generalized. Growth in monetary and credit aggregates during 2009-2010 remained broadly in line with the projections set out in the third quarter review in January 2010. Non-food bank credit expanded steadily during the second half of the year. Consequently, the year-on-year non-food credit growth recovered from its intra-year low of 10.3% in October 2009 to 16.9% by March 2010. The current account deficit during April-December 2009 was $30 billion as compared with $28 billion for the corresponding period of 2008. Net capital inflows at $42 billion were also substantially higher than $7 billion in the corresponding period last year. Consequently, on a balance of payments basis, that is, excluding valuation effects, foreign exchange reserves increased by $11 billion as against a decline of $20 billion during the corresponding period a year ago. Foreign exchange reserves stood at $279 billion as on 31st March 2010. The six-currency trade-based real effective exchange rate, REER, 1993-94 as a base, appreciated by 15.5% during 2009-2010 up to February, as against 10.4% depreciation in the corresponding period of the previous year. Following chart describes the government policy stances to restore the economy in equilibrium.